for joining us for our webinar today. We're in the home buying season, and it's an interesting home buying season to say the least. We were just chatting a little bit before we went online here to talk a little bit about that. So Diane is here with us from FNB, a local lender here that's a trusted business partner of ours for many years. We actually do our banking with FNB. And we asked if they might want to come on and talk a little bit about lending and what applying for a mortgage looks like from the bank's perspective. How are they looking at you? What are the things that they consider, just so that you can be prepared whenever it is that you are applying for a loan and you can get some information about that. So with that, I will hand things off to Diane and we'll go from there.
Awesome. Yay. I'm so excited to be here. So someone was going to help me to share my screen and I can go through a few slides that I have.
Mike, would you please give her the ability to share?
I sure can. Let's see here.
Let's go technology.
Yep. So Diane, you should be able to share your screen.
All right, let's see here. Can you see it?
Not yet.
All right, let me see. Do I need to do anything? Well, I lost you. Okay. Oh, here we go. Share screen.
Okay, you're coming up.
Got it? Okay.
Yes, we're good.
Awesome, awesome, awesome. Okay, so let me get started here. So you could read it all. It looks good?
Yes.
Okay. All right. So we're going to talk about like what does a lender look for when approving you for a mortgage. So I'm going to give you like the down and dirty. I've been doing this for 20 years or more. So I'll give you kind of like a quick rundown about the things that the underwriter looks for, what I look for when I do a pre-approval with a customer. Really the basics are we're going to ask for really minimal information at first, perhaps, name, address, social security number, birth date, all those things allow us to pull your credit. We're going to need income information. And, depending on where your source of income is, might be a little bit more detailed than others. We're going to talk about what your assets are and how much money you have to work with for a down payment. So those are really kind of like the basics that we start with. And what we do with that information is the three most important factors that the underwriter is looking for is your willingness to repay the debt. And so that's going to be evidenced by your credit report, right? And then maybe if we have to check any like rental history. So how do you handle paying other people? So that will tell us how you're going to pay us. Your ability to pay is determined by what your income is, what kind of debt you have, and then how much you have in assets. And then we also look at the property. So basically credit, income, assets, and then the property. And so I want to make sure that people don't feel like, because sometimes people, they're going through this process and it feels like, oh my gosh, there's so much scrutiny. And it really is nothing personal. I want to make sure everybody knows that because everybody asks these same questions. You can be a high level executive, or you may just have like a minimum wage type of position. We ask the same questions, and it really comes down to the lender's risk. It's their money. And I call it them because it's not my money. So it's their money and we have to play by their rules. And so my job as a mortgage banker is to help you to understand their rules so we can get you approved. So think of it that we're looking at from their risk. So here's first part is the willingness to repay is your credit scores. And this, when I first saw this little spreadsheet, I don't know, this is a few years old, so it could have tweaked a little bit, but like if you look at someone that has like over 800, the chance of them going into a foreclosure or a default of a mortgage is 1 1 in 1,292 people. So that's why they say credit is king. So that would put you, I mean, even if you have a 760 credit score, you're still considered like an A+ credit risk, and your chance of foreclosing is 1 in 597. So that's awesome. Now, as you kind of scroll up, and if you are maybe like a 620 or a 640 credit score, and you're like, why do they need my rental verification? My friend didn't have to get their, didn't have to talk to their landlord. That's why the risk of, say, that person is 1 in 26. So you figure you're in a classroom setting, you're taking a small class somewhere. That's like 1 out of 26 people is more than likely to foreclose. So that's why they're going to ask a lot more questions. And then even the way the environment is right now, if you're under 600, what's 1 in 8, 500 credit scores, the chance that now again, this isn't like for real, but these are just statistics that, someone with a 500 credit score or less, the chance that they're foreclosing is 1.3 to 1. And, that's where we want to get people into credit counseling. This is just a one-time picture of your credit. So please, if someone is listening to this and they are in that position, don't feel bad. Things happen, life happens. What we will do is work with you with referring you to people that can help you to get it up. Because I've helped people that have been in that range. After a couple of years, they're still able to buy a house. It takes some work and some dedication, but it can be done. So don't be discouraged. And if you're in the good range, then good for you. I'm proud of you. I'll make your job easier for getting a house. Now, how scores are calculated is different on a mortgage. So keep this in mind, because people will say, well, I go to Credit Karma and they said my score is 740. Why do you say my score is 680? This is why. The way that the scores are calculated, credit utilization is 30%. So what that means is if you have a credit card that, say, has $1,000 limit and you are at $999, your score is going to be lower than someone that only has a $100 balance on it. So credit utilization is really critical. It's a real quick and easy way to help someone improve their credit scores is to talk with them about paying down their credit card debt. If you can keep it at like 30% or lower, that's going to actually give you a little bit of a better score than even 50% utilization. And then once you start getting into like 60, like 75, 80%, then your scores are going to be a little bit lower than the person that isn't.
Diane, so if you're like me, and I'm one of those freeloaders where I use my credit cards and pay them off every month to get the points, is
Yes.
that hurting my credit score?
Only if your credit limit, if you're up against the limit.
Okay.
Like if you have a credit limit of $5,000 and you're charging $2,000 every month and paying it off, you're good because you're under the 50%. No, but there are a lot of people like you, and you're so, hey, you can fly for free then. You get you get the points. But no, that's a really good question for sure.
So, but I guess the question though, so even if you pay it off every month and you approach the limit every month, that still hurts you.
Because credit scores, it's like just a snapshot in time. So you could be good, but then what if it's when you're maxed out when we end up pulling, then, and that's why people are like, how come my scores change? Because people have like the monitoring sometimes. And they're like, within a given month, my score may swing like 30, 40 points. And that's probably why.
Okay.
So pay that credit card off. Don't use it for 2 weeks before I apply.
Yeah, exactly.
Or get your limit raised and only use what you normally use. So
yeah, get your limit raised. That's one of the strategies that we will often tell people to do. Now, make sure though, when you tell them to increase your limit, that you say, please do it without pulling my credit scores, because then you have an inquiry. And as you can see on this little grid, 10% of your score is calculated by how many inquiries you have. So just want to be careful, like, especially when people are buying a house, like around the holidays, they will, or like around vacation time, that they're going to, get a cheaper airline flight if they buy a credit card, or if they're doing Christmas shopping, excuse me, sorry about that. Then you want to be really careful, because if you have a bunch of inquiries and then you have our mortgage inquiry, it could drop your scores a little bit. And then payment history, 35%, where I think, maybe other credit scoring models, they look at payment history a little bit as a higher percentage of that, means like paying on time. They also take into your credit score is determined by the type of credit that you have. Like, say all you have is a bunch of credit cards, but you've never got like an installment loan. You may have a different type of score than someone that knows. That shows, gosh, I'm so sorry. Excuse me 1 second. Talking too much. Okay. So the types of credit. So if you have like a car loan and you have credit card loans, that just shows that you know where to go and what type of credit to use when you're in a given moment. And then credit history. I find that the younger people, their scores are a little bit lower because maybe they just have less than like 12 months of a credit history, compared to someone that is more mature and they have pages and pages of credit. So I often refer to this for people whenever they're like, how come your credit score is different than what I'm pulling on my own, like on my Discover bill? That, your Discover bill telling you your credit report, keep it with a grain of salt. It's not always, you don't want to like think of like, this is going to determine my lending decision, because it very likely will not. So now we're going to go into ability to pay. So the ability, one of the factors is your employment. We're looking for at least 2 years of work history. And then if you do have some folks that are listening that are, have college experience and they've only been 1 year on their job, that's okay. We can count their college coursework towards that employment history. Now, we like the people to be in the same line of work. So if you're somebody that has changed jobs a lot, but you're staying, like, say, in the same finance industry or the same, mechanics industry or something like that, that's perfectly fine. If you're improving yourself and bettering yourself every time, that's great. If there's more than 3 months of gap between jobs, then we will require a letter of explanation. But usually if it's a good explanation and we can understand, especially now with COVID, there's people that have had to make some changes. We'll look at that. We will require a verification of employment, which is a form that we send to your employer that they fill out, that we will match up with your pay stubs, W-2s. Again, it's a lot of auditing. It's like so many checks and balances. We check your employment like 4 different ways. Verification of employment, we call them right before closing to make sure you still work there. We get your pay stubs, we get your W-2s, we get your tax returns, and we send to the IRS to match up with your tax returns that what you sent to the IRS is the same as what you gave us. So thank you, all the people that have done fraud. It causes stress for the rest of the people that are not. And then self-employed people, they are, we need to see 2 years history at a minimum, and we will want to see your tax returns. W-2 people, maybe during a pre-approval process, if you say, yeah, I make 50 grand a year and this is my salary, I've been there 3 years, I'll believe what you say, so to speak, because it's, what your income is. Self-employed people, a lot of times are like, I don't know what I make. My accountant does that. So what we'll look at, like, say, a Schedule C person, like, let's just say maybe a real estate agent, for example, or even like your Legal Shield folks, they may do like a Schedule C. So your gross income is great. We'll look at that. But what we really pay attention to is what your net income is. So if you made $100,000 gross, but you only showed that you made 30,000 net after all the expenses, we're going to qualify you on that $30,000 because that's what you told Uncle Sam you made. So that can be, sometimes people get really confused with that. So that's why it's good. I always ask during the pre-approval process to see your tax returns. So, because the last thing I want to do is pre-approve someone and then I have to take it back once I see the documentation.
Diane, for self-employed folks, are there certain types of business expenses that don't count against them so much? So for example, if they're expensing a vehicle or office space, like in their house or something like that, are there certain expenses that don't count against them as much, or you're just looking at their net income?
No, that's a really good question. There are things that we can quote unquote add back in as income. Like if you write off depreciation, that's an automatic add that. So in my example of someone that has like $30,000 net and they have 5,000 in depreciation, now we can use 35,000.
Great. Yeah.
That's a good thing. And then if they like mileage, a portion of that can be added back. Sometimes use of, using your house, we can add back. We'll also like say you write off a car payment, then I need to know that because I don't want to hit you with the car payment that's pulling up on your credit report. And then also you reduced your income because of that car payment too. So that's where having a conversation about like the line items on there and what the expenses are good so that the customer, knows like this is the income that we can really use.
Yeah. Is there sort of a list of conventional wisdom or hints or tips or something that self-employed persons can have available to them before they send stuff in, just to say this is, because I think are a little bit, I'm sure that they present a little bit of a challenge for lenders, right, to evaluate,
Yeah.
and probably take a little bit more time and effort. Is there something that self-employed people can do to make your job easier, or the bank's job easier when you're evaluating them, that they can point things out or have things ready?
Yeah, I mean, really, especially depends on how complicated. If it's a simple Schedule C person, then, having a conversation with your lender, is pretty much all that's necessary. If you are someone that has a bunch of K-1s and you own several businesses and there's a lot going on, giving us the ability to talk to your accountant and having your accountant be open to talking with us. Because sometimes they're not like, sometimes it feels like they're angry at us because we're questioning what they're doing. And we're not, we're just like trying to understand, and there's certain rules and we don't make the rules. It's Fannie Mae a lot of times, or FHA or VA that makes the rules. So honestly, the best thing is as soon as a self-employed person even gets the inkling that they want to move, they need to have this type of conversation. Because I've instructed people while we're like, say someone right now wants to buy a house and maybe they've only been self-employed for a year, they need to wait till next year. Then we'll scrutinize the tax returns that they have and say, okay, well, next year, maybe don't write off as much, because we want to be able to bolster how much income you make. And I mean, I've even had people go as far as like revising their 2019 returns, for example, so that it shows more income. Because they're like, I would rather do this than, and pay Uncle Sam more money because I really want to buy this house now.
Yeah.
So, there's lots of things that we can do, but once it's done and it's in with the IRS, it's really kind of hard to go back unless you're going to submit revised returns. And I recommend like, let's really have a conversation about that, because then underwriting can be like, okay, what's that about?
Yeah.
So
you don't want to present them anything unusual, right?
yeah. So that's why having a conversation with your loan officer that gives you the tips of, the pros and cons, and then you got to be careful too, because I've been asked before, like, well, can you like just pretend like you didn't see it and I'm going to go back and change all this? It's like, no, you really can't do that. So yes, but anyway, that's
That's
having a
helpful.
having a good conversation is good.
That's one of the reasons why I suggest to so many people why having a banking relationship is so important, right? And talking to your bank and because if sooner or later you're going to need to borrow or need some capital or whatever, and having that ongoing relationship with a lender is very valuable. And I think a lot of maybe businesses found out the hard way through the PPP loan process that if they didn't have a good banking relationship, that may have, negatively impacted them on getting in line, especially for that first round. A lot of
Yeah.
folks kind of got shut out on that. But anyway,
It's very true. I mean, it worked out well for us. We attained a lot of customers because during that PPE period. PPP yeah, for sure. Okay, so let's keep going here on the next stage. So we talked about this a little bit in the previous slide in terms of income. We'll look at your W-2s. We're going to look at pay stubs. Any kind of variability is going to be explored. We're going to look to see if you have any money that's automatically coming out, like for alimony or child support, because that will count as a debt, which we'll get into later. I work with a lot of physicians, and so we'll need like a copy of like a lot of, say, physicians that are residents that are like moving to, with all the great hospitals we have in the area. They're moving here. So we'll need to see like, okay, what's your contract? What's your anticipated income and how long you're going to be here? All that kind of stuff. And then how this is calculated is really important, especially for the variable people, like your commission person, like your shift work person, someone that maybe works in the union hall and they have unemployment as part of their income. And, plus sometimes we have customers that are, work through the unions that they have maybe 20 W-2s, which is all fine. We just need to, they have to be good with their paperwork because we'll need copies of all those W-2s. But then what we'll do for those types of situations where the income is variable is we will average over like the past 2 years. And right now, especially with COVID, underwriters are being really, really cautious. So if you showed like, say in 20, you made less money than you did in 19, they're more than likely going to use that lower number from like the 2020 income than they will with including the averaged, just because we're not really sure how things are going to shake out yet. But again, talking with someone, like myself is so important before you get your hopes up for, anything. And then sometimes people are surprised that they can qualify for more. You don't want to prejudge if you don't know the business. You want to talk with experts. So next section is assets. And this is always so much fun. I feel like people get crabby mostly about this because we look at, 2 of your most recent bank statements. And unfortunately, we scour those, not so much. We don't really care where you spend your money. So if you are a Starbucks addict, we don't care. How much you spend there. We're looking at the deposit column. And so, if we look at, all right, your paychecks are automatically direct deposited. Okay, great. That makes sense. But then if you make, say, $5,000 a month, and then all of a sudden $2,000 went into your bank account, like with cash, we have to question where that came from. Because now bankers are charged with anti-money laundering regulations. So we have to look at that too. So we'll have to document getting gift money is all perfectly fine, but we have to get the paper trail. So if grandma's giving you 20 grand for your down payment, that's awesome. But grandma needs to sign a gift letter and grandma needs to show us her bank statement of the money coming out of her account and then going into your account. And sometimes I've talked to a lot of grandmas, a lot of uncles and aunts. They're like, why do you need this? It's nobody's business, because they don't want to show us, their bank account, but it's just part of the rules that we have to do the paper trail.
I've learned the amounts that you get charged then credited back for Stitch Fix. Is that like a new kind of money laundering, right?
Right. Right. Exactly. Now that's not going to be questioned so much with the paper trail stuff,
Stitch
unless
Fix, not question, not question.
Stitch Fix does a good job of like labeling. Okay. Yeah. Yeah. But I mean, and even simple things like, excuse me, like I know some of the banks are really notorious for having like a spend account, a reserve account, all these different accounts. And people, they push money around all the time. And so then it's like we have to match up like, okay, so account number 12 is showing a withdrawal. And this account number 15 is showing a deposit. And so we have to match it up. So sometimes it's like we feel like it's cat and mouse and like we're chasing things. And then we're like, sorry, one more bank statement. We saw this $5,000 coming from your other account and we don't have that bank statement. Can you get that to us? So, I mean, please, when you're talking with your clients, please tell them we're not trying to be mean, make them annoyed. It's just part of the process. And so again, we're checking that the money is in their account. If it's a shared account, sometimes like their mom might still be on their bank account from when they originally opened it. We'll need a letter from mom saying, hey, my kid has full ability to use these funds. And then also you can use your retirement money, which I've had a lot of times people will use. They'll be like, you know what, I'm not retiring for a long time and I'm going to make up for it. I'd rather buy a house. So they pull it from their retirement, their 401k. That's all fine. We just have to look at do the paper trail. And then a lot of times with certain programs, we need to show 2 months of, I have their PITI, but that's principal, interest, taxes, and insurance. So we'll need to show that after closing, you have at least 2 months worth of mortgage payments still available in your some type of savings. I mean, it can even be in your 401k because we need to make sure that, if you had an emergency, you have at least a couple months worth of mortgage payments to hold you. And then the more down payment you have, the more reserves you have, like, because all of this information goes into the application and then we send it to like a processing system. And in like a minute, it will come back, it reviews all the data, income, assets, the credit, and then it'll come back like bing, either approved or denied. If it's denied, that's when I play. So if it comes back like with a marginal situation, like maybe someone that does have like a 676 credit score and they're only putting like 5% down or even 3% down, if I can show more assets, even that they're not going to be putting more money into the transaction, but I may say, hey, do you have a retirement account? Do you have any other bank accounts? And sometimes just even adding an extra $5,000 in retirement makes or breaks. Then all of a sudden it's like, ooh, we're approved now. So, we can kind of play with that stuff to work to get the loan approved. And reserves are a good help with that. Seller assist is another option to help with, to pay for some closing costs. Caveat, right now, an offer with seller assistance is kind of not looked at as favorably, just because the seller has 5 offers to choose from. They see that you're asking for help and you're offering the same price as someone else, but then they want, you're asking them to give them $5,000. It's not going to work, most likely, unless you increase the price that you're offering them. So that's the asset piece. Current debt, what we're looking at is ratio. And what that is 31% of your gross monthly income can be your house payment. And then 45% of your gross monthly income can be for debts and that new mortgage. Now, FHA lets you go, and sometimes even conventional let you go up to 50% if there's some of those compensating factors, like I was saying about like having a little bit of assets left over and that kind of thing. But this is something that you really want to talk with someone like myself about. So people may think, oh yeah, I can swing a $2,000 a month payment, but we have to make sure based on these ratios that you can swing that. They're going to look at how much you're paying in your current housing, but again, those numbers are important factors. And what's calculated in that is installment debt. So like car loans, student loans, what else? Like alimony, child support, those kinds of things are calculated in there. And then like revolving credit cards do count, but we're only going to count like the minimum monthly payment. So if you normally, say you have a balance of $5,000, but you always pay like $400 a month, we don't have to count 400. If the minimum payment is only like $50, that's what we use for calculating the ratios. If you've co-signed a loan, if you're thinking about buying a house anytime soon, and then you have someone ask you to co-sign, you don't want to do that because that's going to count against you in the debt to income. And then, like I said, alimony, child support, all of those things. And then here's the thing too, which we really got to be careful about. And I tell people this during the application process or even before. Once you're pre-approved, don't change what your debts are. We'll have sometimes people be like, oh yeah, I bought a car since, and it's like, oh my gosh, now we have to recalculate these numbers. Or all of a sudden, yeah, we're so excited because we're closing next week. We bought a house full of furniture on credit. You don't want to do that because then all of a sudden you could have the furniture but no house. Because we know, and this is like, people get frustrated, but we know everything. Like we just find out because we do a soft pull right before you close. So, and that means we'll look at your credit. Doesn't count as a hard pull, what's going to impact your scores, but we do a soft pull and the credit reporting agency gives back to us of any changes that you have made with your debt structure. So that's where we find out. And we're like, oh, well, you pulled my credit last month. How did you find that out? This is how. Yeah. So then finally,
we have sources at our house.
we have sources and even like underwriting, actually, it's funny, Mike, but even underwriting has sources that are deeper and stronger than what I even have access to. They have like these fraud websites that they go to, and sometimes they'll come to us and say, okay, you didn't note like this certain property on their application, but our fraud alert said that they own a house in Vegas. And so then we have to go back to the customer and say, hey, do you own this house in Vegas? And then it might be like, a relative that has a very similar name or something like that. But we still there's so many checks and balances because of dealing with fraud, which is like what you guys are focusing on, right? Like people stealing people's identity. I mean, that stuff exists. So that's why we're doing it. That's why it's great to have Legal Shield. So you don't have, you're like, no, ahead of time. So in terms of the value, we are going to, in most cases, we're going to send someone out to the house to make sure it's worth what you're paying for it. We are going to notate, the appraiser will tell us if there's something wrong that makes it not livable, not safe. Anything that is cosmetic, like welcome to Pittsburgh, so many houses are from were built in the 1950s. And so you will have, say an elderly family has lived in the house for 50 years and they still have the pink tub and the, and the yellow well, I guess the green and yellow cabinets or orange or whatever colors. I think those are coming back though.
Brown appliances.
Yes. Yeah. There you go.
Almond.
Orange. Yeah.
And that stuff is really okay. The cosmetic we don't care about as long as it's safe. But if the appraiser sees like that, there's like this big wet spot in the ceiling that looks like there was a problem with the roof, or significant, Pittsburgh again, here we are, that you do have dampness in the basement. But significant dampness where there's like puddles, or mold or something like that. The appraiser takes pictures, and then we will, in almost all the instances, say, let's get to the bottom of this. What's the problem? And then those things would have to be fixed before closing. And then that becomes something that is negotiated between the buyer and the seller. So the minimum down payment programs like FHA, like VA, which has no down payment, they're going to scrutinize the house pretty closely, just to make sure, because, we know that the people don't have a lot of money to fix it up once they move in. So we want to be sure that the place is safe and sound for them. And plus it's our collateral too. If we have to end up selling it, we don't want to have to do a lot of work to it to flip it. So types of loans, we'll just go through this real quick. I'm not sure. I hope we're okay on time. Conventional loans, there's which are called conforming, or more like called Fannie Mae and Freddie Mac loans. Typically it's 5% down. You can ask for 3% in seller's assistance if you're putting less than 10% down. We do have a first-time home buyer program that's 3% down on conventional loans. And even at First National, depending on income requirements, we even have a 0 down loan for first-time home buyers. So, lots of options out there. The thing with conventional loans, why those are good, is you have a lower mortgage insurance cost if you have good credit. This is a lot more credit score driven, like with that grid I showed you. With each, like say 20 points, it could change your interest rate that you're offered. So, someone that has a 760 credit score might get a little bit better interest rate than someone that has like a 720 even. The debt to income is sensitive. A lot of times we're maxed at 45%. We can maybe tweak a little bit higher, and they require reserves. Now, FHA, it's only 3.5 down. A lot of times the rate is a little bit lower than conventional. There is mortgage insurance, which is a set number, which is a lot higher. So if someone has good credit, I don't see any reason to do an FHA loan, really. Plus, given the environment that we're in, a lot of sellers don't even want to entertain an FHA sales agreement, unfortunately, right now, because they're worried about the appraiser being more picky of the house.
They are a pain.
Yeah,
A little more time consuming and energy.
Yeah, I mean, they're going to be more picky, like handrails and chipping and peeling paint and stuff like that. But they are more forgiving on credit. They're more forgiving on debt to income. And then you can ask for up to 6% of seller assistance for FHA loans. And then finally, VA loans, no down payment. I mean, it's a great product. I'm doing a VA loan as soon as he can find a house, and he's buying up to like $1 million home, and he's using a VA loan. There's no down payment. So it's awesome. And the interest rate is still like super attractive. They don't have what's called mortgage insurance, but there is something that's called a funding fee. And so instead of that being added on monthly, it's a fee that is added on top, and it can be anywhere between 2 and 3.5%, depending if the veteran has used their eligibility before or not. And that amount is just added on top of what the loan amount is. But if someone has a disability and they're receiving a VA disability income, that funding fee is waived. That's my customer that I'm working with right now. So it's like such a good deal for him. But in this instance with VA loans, now again, it's tough to get the seller to agree, but you can have the seller pay all your closing costs and all your prepaids, all the funds needed for closing. And you can pretty much buy a house with not any money out of pocket, maybe pay for the appraisal and credit report or something. And now the appraisers, we don't have any say on appraisal assignment. The VA, we go to a website and the VA picks who the appraiser is going to be. So that's kind of like the luck of the draw on those. So last slide is important questions that that your lender should be asking you. What is your comfort level for your mortgage payment? I may tell someone, yeah, you're pre-approved for $4,000 a month. And they're like, well, I can't do that. So make sure that you're comfortable with that. Just because I say, or your bank says that you can qualify, you want to look at what your budget is. If you want money to go on vacation every year and you have that set aside, or you have childcare, you look at your own budget. How much money do you want to spend up front is another important question. Even though you may have a bunch of money in your savings, how much of that do you really want to spend on this transaction is an important question. What are your timing needs? Do you need to close like in 30 days? Do you need to close in 90 days? Those all impact what the interest rate's going to be and how quickly things can get done. What's your comfort level with interest rate risk? Like right now, we have some really nice adjustable rate programs. And so I've used some ARM loans where the rate might be like 0.25%, which isn't huge, but still, like if someone I know as a physician is for sure going to only be here for 5 years, then we do like a 10-year adjustable rate, which means the rate's fixed for 10 years. They're getting a little bit of a tweak, and they don't have to do a 30-year fix. But if it's someone's like, oh my God, no, I'm too scared, I'm not doing an adjustable, my life could change, then that you just kind of ask the question, like you want to know, what is your risk comfort level? And then how long do you plan on keeping the home too is an important factor when determining the type of loan program that you want to use. So that is it. Blah, blah, blah. So I hope this was helpful. Any questions?
Any questions?
No, thank you for presenting. That was very informational.
Good.
I do have a couple of questions for you, Diane.
Sure.
So first question would be, let's say that somebody, their credit score results in a higher interest rate. And they work to improve their credit score, right? When would refinancing be justified? Are there any conventional wisdom in that regard?
Yeah. It just depends on like keeping track of that. Like I can give you an example right now. I had a customer that they wanted to do a cash out refi, and their credit scores were probably like around a 670, because they wanted to take cash out to buy a second home. And so they did that. We did the cash out refi, we did the purchase for the second home. And now they've just reached back out and they're like, you know what, we really improved our credit scores. He got like a really nice big bonus at work. So one of his issues with the scores being lower is that utilization thing. He was kind of maxed out on credit cards. And he was like, we do this every year. We just throw it on the credit card. We get points. And then we pay it off when I get my bonus. So now we're just trying to figure out the timing of, getting his scores high enough, because I think his refi was like a 4.3 just, 5 months ago, which is considered high, with how things have been lately. So, if we can get him down a whole percentage point in just like those 4 months, even though he's going to have to pay closing costs again, it could make sense to do it,
Sure. I would imagine the savings on interest expenses over the life of the loans would be pretty significant.
Well, and his loan amount is like around 350. So that does make a difference. Now, if someone is like, less than $100,000 is their loan amount, it probably, I've done this, obviously I've been getting a lot of refinance calls. And even if it's a percentage or even 2% with a smaller loan size, that impact of the rate difference in the payment, once you pay those closing costs again, it doesn't make any sense. Because there's some fixed costs with refinancing that can be around the tune of about $3,500. And so adding that much money on top of, $100,000 loan, that's going to pull away from the amount that they're saving with the interest rate, So,
Well,
yeah.
thanks. My second question relates to mortgage insurance, so PMI. And I always encourage buyers to be wary of the PMI, right? are there any strategies that you can suggest to folks post-closing to try to stop paying PMI sooner?
Yeah, that's a really good question. I think if there's any way that people can prepay their mortgage, like add more to their current payment. Like I'll tell people, like if your mortgage payment is say like I don't know, $2,300 or no, let's say 2,325. Just tell yourself your payment's 2,400. And then that extra $75 is going to go towards principal because you got to know that in the first 5 years, that's where you're paying the most interest. So, as you can whittle away and pay down that principal balance more quickly, then you're going to be able to be closer to that eliminating the PMI.
Mhm.
Now, again, this is where having conversations with your bank is really important because as the institution of how this all works is the bank is required to remove PMI once we get to 78% loan to value. So what that means is that you have 22% equity in the house, and then it automatically just falls off the books. However, what they're using is the value that the house was when you bought it. So like think about all the people right now that even bought their house a couple of years ago, their
Mhm.
value is probably a lot better. So if you do have any clients that, or anybody listening that maybe you put 10% down and you're still paying PMI and you bought the house, a few years ago and you're finding out that all your neighbors they're going to get a lot more for their house, then contact your lender and say, hey, I want you to have review this to see if I still need PMI. Now, what may happen is you may have to pay for an appraisal, but it's worth it. Over $500 to get an appraisal to remove your monthly PMI charge. That would be great. So.
Will the bank require an appraiser that it has ordered, or will it accept an appraisal that you've had done by a certified or a qualified appraiser?
That's going to vary depending
Yeah.
on your lender. And I'm not even sure, I apologize. I could find out for you. I'm not even sure what FNB's stance is on that. More than likely, because most banks are conservative, they may require that we do the appraisal because they may not trust, again, because they're always looking for risk. They may not
My
trust.
my cousin Lenny, who's the
Right.
appraiser.
Yeah, exactly. Yes. You get an appraisal. You get
That's
an
right.
appraisal.
That's right. This place is like a Trump place. It's great.
Right. Should switch out the pictures.
Right. Exactly. A little gold on it.
Right. Yeah.
Well, those are the questions that I had. Any other questions from anybody?
It was very informative, really
Yeah,
informative.
very good.
Thank you.
A lot of good little tips in there.
Cool. I'm glad.
Well, Diane, thank you so much. I know we're going to have you back. Do we have the next date scheduled for Diane? I can't remember.
I don't remember.
We do have another date scheduled. I'm looking, see
I
if
think we're together maybe in May or June.
It is in May, and I think I'm going to bring like Eileen or someone, I think, to talk about investor stuff, I think is what we have on the
Okay.
calendar.
Well, great. Well, we'll be looking forward to that.
Yeah. May 19th is what I have.
Okay. Well, thank you very much, Diane. Thanks everybody for
Thanks.
attending today. We really appreciate your time.
Thank you for the
Thank
opportunity.
you.
Great to see you guys.
Bye-bye.
Bye-bye.